All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. A little bit of a different style open to the market here this morning, so let's go take a look at that. But before we do the challenge, no new trigger on the board here this morning. If we look at the scans, the upside crossover list is empty again, and the downside crossover list only has 3 stocks on it. Here, Honeywell, Oracle, and Vale. Interesting mix, but these are not moves that suggest, further downside or a big downside trend to come. Not something that I can get into here. FedEx yesterday, right? Which I mentioned I think would trigger, right? And I got asked about this, and so I said I'd comment on it here this morning. It's not that it didn't have a downside 3-7 crossover. It's not that, it can't go lower. In fact, I expect it to. When it comes to the algorithm, it's looking for a probability of moving 2 average true ranges. And where FedEx had an issue yesterday was 2 average true ranges is $7. Can it move $7 from this level? Yes, it can, right? But the odds of it doing it within the ATR method were significantly lower than what I thought they would be, and that's why it didn't trigger in this specific case. And so it's one of those things where I get, hey, some people are looking, hey, what's going to happen tomorrow, and everything else. But it's a matter of what is the probability of it moving 2 average true ranges, and is there a high probability of that? And if there is a high probability of that, then great, it's a signal, go. If the probability is low, then it's not something that's going to signal, and it's something that yes, it may go down the next day, and yeah, I may have been able to buy a put option and make some money on it this morning, but that's not what it's looking for on a consistent basis there. All right. So anyway, some things that are shaping up, could trigger here this afternoon. We'll see. I'm not a big fan of being in all cash right here, but we'll take them as they come. We do have more and more companies reporting earnings, so earnings are starting to come out of a lot more names, which make them significantly more tradable here as we go forward. We do see the banks, which have weakened nicely here and, pulled on back here a little bit. It does put them in a situation where we could see an upside signal on them if the pullback is light. But that's not going to happen today or anything like that with a JP Morgan or Bank of America. But this is a very different reaction in these stocks than what we have seen in prior earnings seasons. One of the reasons, and we've talked about it, is the comparables just simply are not as good this year as, what they have been. And that just makes it a little bit of a different environment where, you take something like IBM, the earnings on JP Morgan were better than IBM, but the reactions are going to be a little bit different when those comparables are such. All right. Now, yesterday we had a change happen in the MarketVibe. Now, this change wasn't big, but it could feel big. Why? Well, the MarketVibe went from bullish to neutral. And the MarketVibe has been bullish pretty much since October. It's had a few neutral days. There's a little bit of data missing out here at the beginning of December, the middle end of December. Most of that missing data are bullish days that being rectified. So my apologies for that. But you can see it has been a long spell of very, very bullish conditions with the market internals and with the MarketVibe. Now, yesterday it turned neutral. Now, it's still a 4, right? And we saw this happen back in, November of last year, where, it turned neutral. It went from an 8 to a 4 or 7 to a 4, turned neutral for a day, and then, market just kind of went back to what it's doing. Well, we got a neutral signal come in yesterday here on the MarketVibe, which is a change from what has happened. Now, Going from bullish to neutral doesn't mean the next step is bearish, right? That's not what it means. We do not see any evidence in 5 years of the market vibe that say, well, when it goes from bullish to neutral, then it has to go to bearish, or when it goes from bearish to neutral, then it has to go to bullish. They can swap, from bullish to neutral, back to bullish, back to neutral, from bullish to bearish to neutral to bearish. It can go in all those different directions. So please don't make the jump of, well, it goes to neutral, so it's got to go bearish. But what are we seeing? We are seeing that the bulls still control the majority of the metrics, but their grip on that control is weakening to a degree that warrants a small change here. Now, what's going on? Well, if you take a look at neutral, right? Since September 2015, there have been 367 neutral days. The average daily gain is 0.01%. Neutral days have been very flat in the market. And yeah, sometimes there's an up day through them, and sometimes there's a down day through them. But overall, they balance themselves out, and the performance is very, very different from bullish days and bearish days. And so that's what the market what the market vibe signaled here yesterday, and something that do have to take into account. And it's the first neutral day of the year, right? All 12 days this year have been bullish. It's average daily gain of 0.22%, which actually beats the overall performance, and tells you just how strong the market has been, to the start of this year. But we do see this change coming into play. Now, this isn't a change that's affecting all metrics. For example, the bullish percent index, it's still in a bullish position. Yeah, it's pulled back the last 3 days, but it's only pulled back 2 points. That's still a relatively bullish position, right? If we look at things like the number of stocks above the 7-day moving average, which has moved this morning, but it's still more than 50% of the stocks are trading above the 7-day moving average. If we look at the 20, right, we still have more than 62% trading above the 20-day moving average. So we're not looking at mass breakdowns, right? But the numbers are a little bit less than what they have been. Where we have seen the erosion is in two spots, right? One of them is in the volume flows, and this has been a small erosion, a very small erosion, and I'll show it to you here. This isn't, the market vibe doesn't use this chart to calculate it, but this is the best way that I can visually show it. And the thing about the way that it's visually shown is you can't look back in time and go, well, it was here then, so it did this. Because what it looked like back here in December is very different than what it looks like today when we go back and look at it in December. Okay? So, really only the last 2 months, really have any significance here. But we can see that when you take a volume accumulation here of the New York Stock Exchange, and you take the advancing versus the declining volume, we're seeing that it is weakening. And we are starting to see significantly more declining volume come into the market after a long period of being in a very strong buy position. And by that, I mean above this kind of moving average envelope, this 5% area. And when we see the market above that 5% area, that tends to be very strongly bullish. And so while it's not moving below the 5% area, in not strongly bearish in any way, the bulls have lost some of the volume flow, some of that real strong volume flow element that they've had. And we have seen that erode here this week, so far. So this is pushing the market vibe down a point. That's all. It has about a 1 point difference there. But then the other area, and we've looked at this a little bit this week, just comes down to sector performances and what some of these, performances look like relative to the market itself. And if we look at small caps, they're lagging by well over 2%. That's a bearish situation. historically. If we look at the FXI, it's lagging by well over 2%. That's historically bearish. So we're looking at some of these that are, shifting here. The transports, they're not quite a 2% differential, but they're starting to lag the S&P, to a degree that we haven't seen in the last several months. And so we are seeing erosion happen within the sectoral metrics here of the market. Now, where we're not seeing erosion is in the tech performance, and with the tech being 20% basically of the market, and outperforming in a huge way, and it's still a very bullish differential, right? It is going to help to keep the markets up, as long as tech is performing. And so while we saw, a little bit of a different open this morning, where we saw some pretty hefty volumes come in to the downside compared to what we've seen other mornings when we've seen volumes come to the downside. If you go take a look at tech, we still have semiconductors up. We have Apple. Apple, big drop for Apple today. It's down 12 cents, right? That's for Apple. That's a big drop. But Google up $4. We have Adobe higher. We have Intel higher. We have Micron higher with another upgrade. Tech continues to be extremely strong and continues to outperform in this environment. So, it's one where, we do see some sectoral erosion, but tech continues to be king out there, with no signs that is weakening here of yet. Is it maybe running out of some of its, upper magnitude changes? Yeah, a little bit, but nothing that is in a, significant area here for it. And as I talked there, Apple goes green. So all is right with the world, right? All is well. What do we see lagging here today? What do we see underperforming? We see the Babas of the world, things that are exposed to China, right? And if we look at the coronavirus and, some of those concerns that are out there, I know there are a lot of different news reports and a lot of uncertainty there with it. And, heard a couple comments yesterday that, it looks like the market doesn't much care about it. No, it still cares. It's still keeping an eye out. Where we see the selling action happening is in areas, where an outbreak, a greater outbreak of the coronavirus would affect it. With one exception, and that is in the banks. And the banks have lagged. Is it a huge lag? Is it a lag that goes, wow, this is, something dramatic? No, it's not. It's a normalized kind of consolidation more than anything here for the banks, and could be simply attributed to the fact that, hey, maybe some of the banks just stopped buying their shares right now and took a little breather with it, right? So anyway, that's where things sit. All right. They have not gone bearish. They are still in a neutral position in terms of the overall metrics. But we are seeing some shifting happen. We are seeing some changing happen. I continue to stand by the point that I made earlier this year, that when there's a bearish breakdown in the market, it's going to be obvious. We haven't seen anything obvious here. If you just pull up the SPY chart, there is nothing obvious in this where you go, wow, okay, it just did this. And I showed yesterday kind of what obvious would look like when we looked at that Google chart, right? And so far, there's nothing super obvious in this. And so it's not something where I'm willing to go, well, you know what, you got to sell everything you have to the upside and play the downside. We're not there yet. Are there things that can be played to the downside? Yeah, we've talked about them, and we've talked about, yesterday with Caterpillar and, even a little bit of FedEx and, whatnot. But at the same time, there continue to be upside breakouts and things like a Micron and, and things like Lennar that just continue to, just go parabolic, right? I mean, it's absolutely gone parabolic here, and continues to ride up on that upper Bollinger Band. But if the market's going to turn around, if the market's going to go bearish, it's got to see the Apples of the world, the Lennars of the world, the Microsofts of the world stop seeing money go in them. And we continue to see money go in them. Is it a rotation? Is it a rotation into maybe a little more safety? Yeah, I think you can make that argument. Right? Now, we have seen that, yes, the markets have gone higher, but there is a little safety rotation. And yes, that is calling a lot of tech safety. But, when you really look at the growth and the valuations out there, a lot of tech is significantly safer than, some of the Caterpillars of the world, or some of the automakers, and some of the some of the big industrials that are out there. Okay. All right. Last thing to take a look at here this morning is Netflix. I did not comment on Netflix earnings yesterday. And this is something that I went through the earnings report, and I went through it in detail. I looked at all the arguments that are being made out there. I see what the bears are saying. I see that the bears are talking about, Netflix. They missed on subscriber growth a little bit, and whatnot. Was the pullback yesterday justified? Yeah, probably. Is it a long-term story changer for Netflix? Not at all. For me, in fact, the earnings report just kind of solidifies the longevity and the fact that Netflix is here to stay regardless of the competition. Netflix has made strides in the area. They have caused a complete change in the area. They continue to be one of the top dogs in the area, and they continue to show that they do have some subscriber resiliency. That even though Disney Plus came out, and we have other streaming competitions coming out almost every day, that they're able to hold on, and they're able to do pretty darn well. And I do think the earnings in general only solidify the bullish long-term case, here for Netflix, and make it something that I do want to be an owner of long-term. We've talked about that, and then we've talked about how I'm positioned and everything. But it is one that it's had a nice multi-year consolidation here. And, I would not be surprised to see it make that next turn up. I also think there is some possibility, and I don't think it's a great possibility, but I do think there is some possibility that at some point we do see Netflix bought out or taken over. Their market cap starting to get to an area where that becomes very difficult, and where where it's not going to make as much sense to someone like Apple or someone like Google, to step in and do it, or Facebook to do it. Could they do it? They could, right? Money is cheap enough out there right now that they could make it happen. But it's not something that it's not to me a no-brainer like it would be if the market cap were at 15 billion or 25 billion. They've turned into a massive market cap out there. And when you look at different maps, like this one here, that show the size of companies relative to their market cap. So if you look Apple's the biggest one here, right? Why? Well, their market cap is large, right? Pepsi, Coke, their market cap is nowhere near Apple's. So it's not saying, well, this one stock's better than the other. This is just kind of basing them off of market cap. Look how small GM and Ford are relative to Apple. And let's see, I don't see Netflix in here. Oh, yeah, they might not have it in here. But anyway, it is something where it can start to compete. Here it is. You can see the relative size of Netflix. It's not it's not Amazon, it's not Apple, it's not Google or Microsoft, but it's also not Ford. It's not. I mean, it's bigger than Pepsi. It's bigger than MasterCard. It's bigger than a lot of the names that are out there. It's bigger. It's about the size of Boeing. which is pretty incredible there to think about. So, for me, the bullish story is still intact when it comes to Netflix, and I think you can argue that that bullish story was even more solidified, even though the stock went down yesterday. All right. Thanks for hopping on. Have yourselves a fantastic day. We'll talk to you tomorrow or this afternoon. Take care.